All right, there we go. So we got the recording going and we're ready to jump into our presentation today. And the first thing that we're going to get into is a little tax brain teaser to kind of, I'll say wake everybody up. I usually say that in the morning. So hopefully we're trying to keep everybody awake since this is an evening presentation. So first of all, I mean, thanks everybody for joining us and kind of carving out some of your time to talk about taxes on a Wednesday evening. We weren't sure how many people would be interested in this. So we're excited for the number of the people that are interested and want to hear about this. Now, the first slide on the page here that we're going to talk about again is that brain teaser. And if you saw my video, I posted a video on Facebook on our business Facebook page. Was it a couple of weeks ago, I think? Mm-hmm. That was this brain teaser. Some of you already know the answer. You kind of already have the catch at the end. So this may be new for some of you. So I'm going to catch you guys up and go through this real quick. Imagine with me that we've got a client named Bill, right? So this is Bill that you can see on the screen here. Bill is a client of ours that decided to retire last year. He's 65 years old now. And last year in 2020, he entered into retirement. He's excited about retirement, excited about moving into that stage of life. He's at the point now where he's no longer accumulating assets. He's moved into that distribution phase and he's starting to actually spend the money that he worked hard to earn and set aside. And in 2021, we know that Bill has $42,275 in taxable income, which includes $25,000 of Social Security benefits. So as you can see, Bill's $42,275 of taxable income puts him in the 22% tax bracket. So he's squarely in, get my little drawing, whoops, covering it up, squarely in that 22% tax bracket because he's above that $40,525, but he's below that $86,375 mark, right? Now, we know Bill well enough that towards the end of the year, Bill decides he's going to take out an extra $1,000. He's going to give us a call and say, hey, Mike and Jennifer, I just found out that the Rolling Stones are playing in DC. And to make the trip up to DC, I need an extra $1,000 out of my IRA. So the question here is, how much is he taxed on that IRA, on that extra $1,000 that he pulls out? I shouldn't have annotated. I don't know how to clear it now. Erase. There we go.
There you go.
All right. So now the logical answer is that for every dollar of IRA money that Bill pulls out of his IRA, he's going to pay 22 cents in federal income taxes because he's in that 22% tax bracket. Therefore, he took out $1,000. He should owe $220 of federal income taxes, right? That, I mean, sounds simple enough. But again, if you saw my video, you know that that's not the answer. Unfortunately, that is incorrect. Bill actually owes $407 in taxes. It's a 40.7% federal income tax rate on that income, which I know doesn't seem to make sense. It sounds crazy. If the highest tax bracket for a single person, and Bill is single, is 37%, then how in the world is he paying more taxes than somebody else with so much less income? That 37% income tax bracket doesn't start until somebody has $510,000 of taxable income. And he's so far below that, how in the world is his actual tax that he's paying there over 40%? It's higher than the highest income bracket there. So later, we're actually going to explain why Bill faces that tax bill. It's going to be a part of the presentation. And that part I did not share with anybody in the video, exactly where that tax comes from. So we'll go through that and talk about why he faces that kind of bill. But for now, the important thing is to really realize that when it comes to taxes, there's no obvious answer. And the obvious answer is not always the correct one as well. And when you think that you have the obvious or the right solution there, that's not always the answer at the end of the day. So welcome to our presentation. This is how tax planning changes through the 4 stages of retirement. Little introductions, which we have not done yet. My name is Mike Sigmon. A lot of you guys are clients and you know both of us. I'm a financial planner with Summit Financial Partners. We've got Jennifer Luzzatto on the line as well. She is the financial advisor and the owner of Summit here, and we're going to be going through today's content together. So we're going to be kind of bouncing back and forth on different topics as we go. And again, we thank you guys all for signing up tonight and actually carving out some of your time to talk about taxes and retirement. We truly believe that you'll be better informed about the challenges of retirement tax planning after listening to this. Now, naturally, I know that you may be wondering, why is a financial professional giving a presentation about retirement tax planning? Because we're not accountants. We don't prepare taxes. But the thing is, we recently started these webinars or these workshops, these educational bits that we want to do and we'll continue doing on various financial education topics. Last month we did one on Social Security. We plan on delivering others on topics like retirement planning and IRA planning, healthcare planning. We talked about, I think we're thinking the next one is going to be on cybersecurity. So that should be a very interesting, fun topic. Another one is late stage college planning. And there's lots of these topics that we'd like to provide more in-depth education. I know a lot of you have seen our Facebook Live videos, and those are much shorter and a little bit more conversational between Jennifer and myself, and they're not as deep into the information that we're going to be getting into tonight with the tax planning piece. Now, our goal is always to inform and educate our audience, whoever that might be, so that you have a better understanding of how critical financial planning topics are going to affect you and your family. Now, we do this presentation, this one in particular, because we've seen so many people make really small mistakes that end up paying more taxes in retirement than what's really necessary. And when that happens, it makes our job harder because people have less income in retirement, and we have to find ways to help make their portfolios last, throughout retirement all the way to the end. Taxes can be a complex topic, even though the underlying concepts behind taxes are fairly straightforward. We've organized tonight's presentation into four key areas to help you remember what we're covering tonight. We are going to email you. I'm going to hold this up. We've got a soft copy of. Oh, I'm holding it right in front of my microphone. I think I got quiet there for a second. It's a how tax planning changes in the 4 stages of retirement. It's a little PDF that you can refer back to. So we're going to email that out to everybody, as well as all of the content from today's presentation. So we'll email the slides, and that's a really great reference sheet that is essentially an outline of what we're going to be talking about today. So you can refer back to that whenever you need to. I was hoping to email you that ahead of time, but I couldn't figure out how to get it into the Zoom reminder emails. I was hoping to send that in that. But another thing that I want to mention is we've got a printed brochure that's actually a really great guide to taxes when it comes to retirement. It mirrors or it is a great complement, I'll say, to the content that we're going to be going through today. This one, unfortunately, I don't have soft copies of. It's got a lot of information there on taxes and retirement. We'd be happy to mail one of these. We've got a stack of these that we have available to clients in the office, but we'd be happy to mail one of these to anybody that wants one. We have no use for your mailing address. So if you're not an existing client, you don't have to be hesitant to provide that. If you want a copy of that, we're not going to mail any kind of marketing jargon, or that's truly just to send you this. And if you are a client, obviously we have your mailing address, so you can just say, hey, please send that to me, and we'll be happy to get that your direction. And then last housekeeping item that I want to mention kind of before we jump into the information is we want to be respectful of everybody's time. We plan on concluding today's webinar by 8 p.m. So we're not going to go over that hour mark. We want to encourage you to send us questions throughout the presentation, and we're going to do our best to answer those as we go along. We've got while I'm speaking and Jennifer's not, she could be kind of mirroring those questions and vice versa. If we're not able to answer your questions during the presentation or during the webinar, if we have time at the end, we'll answer those. And worst case scenario, we'll respond in an email to make sure that we get you those answers. So even if you have to jump off early, or if there's anything in that stint, we're going to answer your questions as best we can. And actually, I'll also even mention toward the end, we want to provide a link where you can sign up for a one-on-one phone call with us. And that's a complimentary a phone call, whether obviously if you're a client, we'd love to talk to you about any of the topics that you hear tonight. But if you're not a client as well, feel free to sign up. We'd be happy to chat with you, and we can answer your questions there as well. So we'll provide that in the chat, and then we'll follow up with an email with that link as well. So with that, I want to assure you that this is not in any way a sales presentation. You're not going to hear anything even remotely close to a sales pitch. Again, we're just here to hopefully provide some valuable tax information for you.
Yes, but now I do want to interject this before I go to the next slide. There was a question in our brain teaser, what kind of IRA is it, whether it's a Roth or a traditional? It is a traditional IRA.
Was
Good
a traditional
question.
IRA. Yeah,
yes,
great question.
Love it.
Yeah, so that $1,000 did increase his taxable income for the year.
Yep.
Yeah, good question.
Yep. So there's another point we need to make as well before we, sorry for all that we are not tax advisors. Everyone's tax situation is different. So we always say, please check with your CPA after we do a tax analysis as well to discuss your specific tax situation, especially about topics as traditional IRAs or Roth conversions and that sort of thing. And so we do want to make sure that everything is done in accordance with IRS rules and state taxes. So this presentation refers to federal taxes, but most of us are in Virginia. Not all of us on this presentation, or the ones that I know anyway, are in Virginia and some other states. So you'll also have some impact on your state taxes. So check with your tax professional. And so again, we like to use this as a value add to our clients to look for opportunities to better optimize their financial situation. So our goal here is to help you understand that the retirement distribution game, spending assets in retirement, is much different than the accumulation phase when you're saving for retirement. And those of you on this call that are already retired know this so well. Chances are you've been in the accumulation phase for several decades of your life, and you've been working hard and trying to save money, and hopefully your accounts have grown. But now as you enter or prepare for retirement, you're in an entirely different phase, the distribution phase. And the distribution phase has new strange rules that can catch people off guard. And along with those rules, there are often many changes in your own personal life that can have a big impact onto your taxes too. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off, so you might not have a mortgage deduction anymore. If you're already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you've stopped working, you may no longer have the ability to stash income in a 401k or similar plan to manage your annual tax bill. And at some point, you'll start taking Social Security. And sooner or later, when you reach age 72, you will have to start taking distributions from your retirement accounts. That recently increased from 70.5 to age 72 as the beginning age for that. So the list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is absolutely critical. So that brings us to a simple statement about the problem we're here to discuss. Simply put, people often pay more in taxes in retirement than expected because the confusing system treats various income types differently and contains hidden taxes and penalties. In the accumulation phase, people build their assets in several different forms: stocks, bonds, real estate. They might have money in pensions and 401ks and IRAs. And in the distribution phase, your regular wages stop coming in, clearly. You have to take the money you've saved and use it to fund your retirement, which can go on for decades with good health on your side. And that's what we hope to see. That's challenging because you'll need to make informed decisions about the tax implications of tapping different accounts, and it can be costly. In retirement, your tax rate can vary dramatically based on decisions you make, such as the timing and order in which you use different sources of money to pay for your expenses. So poor choices through misunderstanding or ignorance of the rules can result in people paying more taxes than necessary. And as a result, they may see their savings drop faster, which no one wants to see that. And that can mean less to leave to your children or your grandchildren. So there's, an ongoing impact from all this. And of course, we don't want that to be you. And the fact that you're here means that you are willing to work towards a solution, which is an important first step.
Yeah. So yeah, because your tax exposure is going to change throughout the 4 stages of retirement, you're going to need a strategy that really anticipates both the traditional taxes and possible taxes, surcharges, and the penalties that are related to Social Security, Medicare, and other income sources that you'll have in retirement. That means that you're going to need to really have an informed and proactive plan that addresses how to create income in retirement. Our goal for today is to introduce you to the major the major aspects of that kind of strategy, and to show you the challenges that we're all going to face in retirement, and then explain kind of what makes up a workable solution to our retirement tax problem. Now, the first step is to develop an understanding of the types of tax that we may face. You may be thinking, what do I mean by the types of tax? There's a federal income tax, and we are focusing on mostly, primarily today, the federal side of things. But I want to give you a definition of what I mean by tax, because when I'm talking about taxes, I'm talking about all of the costs that can increase as your income increases. So essentially, as your income goes up, costs that are associated with that are only showing up because your income went up, that's what we're calling a tax. And some of those things traditionally aren't labeled as a tax. Increased Medicare premiums, for instance, is a great example of one of those. And we're going to talk about that later. We actually have, I noticed one of the clients that are on today that we had a specific conversation with last year that we saw that just barely trip into a higher income that increased those Medicare premiums. So for the sake of today's presentation, if your cost goes up as your income rises, we're classifying that as a tax. Now, in light of the different retirement expenses that you're going to face, you'll really need to kind of create a strategy that's going to help you decide which of your assets that you have at your disposal to tap into first. How much you should be taking from each of those assets, as well as when those distributions should occur, as far as what years and kind of how to stack those. Getting this right is going to help you pay as low a tax rate as possible. And we're talking about some, I think, pretty significant savings in some cases. Now, before we go on, here are the 4 stages in retirement that we're going to discuss. These are rough ranges and descriptions. Your own personal experience obviously may differ from this. So this is just kind of the framework that we're using for our discussion. First, you can see there's the pre-retirement age, which is typically that 50 to 60 age range. This is still the work and save years. You're still accumulating assets, kind of working toward retirement, but approaching retirement and getting close. The early retirement stage, that's the stage 2 there, is typically from about age 60 to age 70. This stage we call the go-go stage, or the go-go years. Typically, this is people have really big dreams and big plans for retirement. They've worked really hard, and you've got Bill who wants to go see the Rolling Stones in DC, and you've got people that want to plan for lots of traveling or starting new hobbies. We have lots of clients that are entering into retirement, and really is just starting a hobby or something that they can still do for income, but something that they've wanted to do for a long time. That starting, whatever that new hobby or any kind of part-time work, spending more time with family. That again is those go-go years. You've got lots to do, and you're ready to get those done because you've just entered into retirement. Next, you reach the middle years of retirement. This is typically when you're in your 70s, from age 70 to 80, where you start to slow down. These are the go slow years. Things start to creep back a little bit. Traveling starts to slow down a little bit. You're starting to enter that age where you're having to deal with things like required minimum distributions. As Jennifer mentioned a minute ago, that starts at age 72 from your IRAs and other retirement accounts during those years. And then lastly, we've got the late retirement years. This is when your health may not be quite as good, and you're thinking about legacy and estate planning. These are the no-go years that typically start around the age of 80. So as you see, or as you will see, there's lots of different issues that need to be planned for in each of these phases. And this is a lot harder than it seems because retirement is full of surprises. And this is just a list of a few of those surprises that you may encounter. Even the best planning is going to divert from reality at some point. And we're constantly updating plans as things change. We've got clients that we've got a plan in place and something happens, whatever that something may be, that seemingly derails their plan. And we've got to go in and make some adjustments. One future unknown is inflation. And this is something that people tend to view future costs of things in current dollars. And it's so much easier to talk about things in current dollars because we know what things cost today. I want to be able to afford that thing in the future. So that's the cost that we typically go off. However, those costs grow with inflation. We've seen that. We're seeing that it's seemingly a very real thing in the last 12 to 18 months or so, where things like lumber and 2020 put us in a really unique situation in the world where we're starting to see some real inflation on some things. So just kind of being aware of that is one of those surprises that can impact your plan. Or how about longevity is another one. Many people end up living far longer than they expect, and this requires more money at a time when it's difficult to work because you're much later on in years. So how long do you think that you're going to live in retirement? Many people also underestimate their expenses in retirement. They have a pre-retirement standard of living that they're used to, and nobody wants to see that standard of living drop. But maintaining that standard of living is oftentimes more expensive than people actually realize moving into retirement. And then we also have healthcare. That's the 10,000-pound gorilla that we don't like to talk about, but is about guaranteed going to eat up some of your expenses in retirement. This includes your out-of-pocket payments for services and drugs, plus the Medicare and insurance costs, which just continue to rise.
Yeah, and if someone has private insurance before they're old enough to file for Medicare, that is just
very expensive.
It's incredibly expensive. Yeah. And it really does play into people's decision sometimes as to when to retire. So at this point, you may be thinking, so what's the first thing I need to understand about retirement and taxes? Well, here's the first key. You have to know what your after-tax retirement savings picture looks like before you actually retire. But please don't panic if you've already retired. And this is why, because if you have $500,000 in your 401k or an IRA, it isn't really $500,000 because the money is taxed as it is distributed from the account. So the government has claim to part of that money because the taxes were deferred when the money went in. And so that's one reason they start, there are required distributions, is the IRS is saying, all right, we let you defer the taxes and now it's time to start paying it to us. And so the intention is your grows and they actually end up with more tax revenue. So the higher your tax rate is in retirement, the less your account is actually worth. And sometimes that's really hard to really visualize, but it is quite true. Here's an example of that. If you can see this slide, it's a little small in mine and my new contacts aren't that great. So here's an example. This chart shows you the cumulative after-tax amounts you would expect to receive from a $500,000 IRA earning 6% a year at various tax rates. And as you can see, the lower your tax rate, the more money you keep. Kind of obvious, right? Simple in theory, but difficult in practice. And so, of course, this presentation, as mentioned, does apply to pre-retirees and retirees. So don't worry if you've already started taking your retirement. And we've been working through that with clients as well. But tax planning is important throughout your retirement. So Mike's in charge of the slides. So now you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income. And you will. And you'll have Medicare to pay my health costs. And you will once you're 65. But the one thing that you do need to understand when creating your retirement strategy is Social Security and Medicare both have their own kind of tax traps that you need to plan for as well. And to part of the hint with the brain teaser is the Social Security trap plays into what that problem was. So let's talk about Social Security and taxes a little bit here. So here's Bill, our Stones fan. I'm going to date myself and say when I was in high school, the Stones had their last world tour. So I think that was marketing.
Yeah, sure. I don't know if they're still out after COVID, but I know pre-COVID they were still touring.
Yeah,
still out there.
They're pretty amazing. So even though high school wasn't that long ago. So anyway, so let's go back to Bill. We want to understand why he paid such a high tax rate on the extra money that he took from his IRA, his traditional IRA, to go on a concert road trip. So remember, he has $38,000 of IRA income, and part of his adjusted gross income of $56,525 to be exact, is $25,000 of Social Security benefits. And that puts him squarely in the 22% bracket, and he takes the standard deduction. Yet when he took that extra $1,000, he got hit with a nearly 41% marginal tax rate, $407 on that $1,000. So let's break down what actually happens. So remember, the only difference between two scenarios here is Bill's taken $1,000 from his IRA more than expected. And so he has $39,000 in IRA income now. So, so we see here that by adding that additional $1,000 of income, it increased both his AGI, adjusted gross income, and his taxable income by $1,850. And that means for every dollar of income he actually received, he's being taxed on $1.85, which makes no sense. And really, it really makes no sense, but it's true. So here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxable varies. So for instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. But on the other hand, if your income is high enough, 85% of your Social Security benefits are taxable at whatever your personal tax rate is. I'm not saying they tax 85% of it, but if you had $1,000, $850 of it would be subject to federal income tax. So Bill finds himself in this later scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he also must add an additional 85 cents of taxable Social Security benefits. So that's what happened. He got tripped into that where his Social Security was taxable. And if you add that up, that's $1.85 taxable at his 22% rate for every $1 of additional IRA income he actually receives. And if you do the math on that, it comes out to 40.7% real tax rate on the additional $1,000 of income. So that's called the Social Security tax torpedo. And it can impact single filers and married couples with even fairly modest income during any stage of retirement. And it's one reason that tax planning is so important during retirement, is to know when that's going to happen. And Bill might have made that decision anyway, right? It's not saying but at least he would have gone in knowing the impact of his decision. Yep. Because it could have been his once in a lifetime chance to see the Stones and he wouldn't care, which is cool. So let's take a look at another aspect of Social Security and taxation and how people approach retirement. During the go-go year stage, some people retire altogether, but others enter into sort of a semi-retirement, and sometimes it's a continuation of a previous job, but with fewer hours. Others use semi-retirement to explore other interests in another field. So they might take a pay cut, but still be working full-time. And still, some others use semi-retirement to pursue non-paid but rewarding volunteer work. So working in retirement can impact your planning and taxes in a number of ways, some good, some bad, and some pretty ugly. So let's look at how working during these years can be a good thing. Chances are you've researched what your Social Security benefit might be at various ages, but you might not know that your Social Security benefit is calculated using your highest 35 years of inflation adjusted earnings. And there's this complex calculation that takes place that Social Security does where they give different weight to different years of earnings. But if you started working, what if you start working late in life? Or what if you left work for a few years to raise your kids? You might not have 35 years of history. And so what happens is those, what if you only had 28 years of history? That what the IRS does is in that fancy calculation, they put 7 years of zeros, and those zeros are given weight, and it reduces your benefit. So the good news is earnings at any age can help you increase your Social Security benefit and get rid of those zeros. And thanks to how Social Security calculates benefits, replacing several years of zeros with even modest earnings can positively impact what your benefits are.
Yeah, some people automatically, think small earnings, $20,000-$30,000 in a part-time income is not a whole lot, but that's a lot more than zero. That's a big impact on Social Security.
Yeah,
potentially.
Yeah, definitely. So that's definitely worth looking at, especially if you, in my opinion, if you want to have a passion you want to pursue. So let's look at how working during your go-go years can be somewhat bad if you're already collecting benefits and unaware of the Social Security earnings limit that applies to prior to reaching your full retirement age. So the Social Security they discourage working and collecting your benefits before you reach your full retirement age. And this is how they do it. So if you start taking it, be it your own benefit or spousal benefits prior to the year you reach your full retirement age, how many years it is, doesn't matter. For every $2 above a certain amount that you earn, Social Security will withhold $1 of benefits. And it's any amount above $18,960 to be exact in 2021. I don't know how they come up with those numbers. You'd think they would just say $19,000 or something. But keep in mind that we're talking about earnings here, like W-2 earnings. We're not talking about pensions or interest or dividends or capital gains. They don't count, and they don't reduce for this calculation. They don't count. They will not reduce your early Social Security benefits. It's W-2 wages. So if you earned $20,960, $2,000 over the limit in 2021, therefore under there'd be $1 under the $1 withheld for $2 earning rule. Social Security would withhold, I cannot talk tonight, with $1,000 of your 2021 benefits. But the good news is they're not truly lost benefits. When you turn full retirement age, your benefit will be adjusted to make it as if you had applied at full retirement age with respect to those withheld benefits. It doesn't reverse everything you've done, but by retiring early and taking your benefit early. In other words, your benefit going forward will also be a bit higher. Also, in the year you reach full retirement age, there's a separate higher earnings limit. They don't penalize you as much in that year that you do turn full retirement age. All right, so we've talked about the good and the bad, which does have a silver lining, I would say, but now you get the ugly, and that is taxes and retirement, which is the whole subject for today. But there are other taxes you may face too. For instance, while you're working, you're subject to the 7.65% Social Security and Medicare taxes, in addition to your income tax. And the self-employed pay twice that amount. They pay both sides of that, basically, for 15.3%, because they're paying the employer and the employee portions of it. So those taxes don't go away if you're working past your full retirement age, or even if you're collecting Social Security. So worse, in your go-go year earnings don't make it into your top 35 years, those Social Security taxes go into the trust fund, but they do not increase your benefit. And so it'd be very unique to each person based on what your earnings are and what your earnings history is. But you could be paying taxes that that you really would never see a benefit from. And
Jennifer, we got a question on that last slide.
Yeah.
I went too far forward. I'm gonna go back one. Would 1099 income count toward that? Miscellaneous income?
I do not think so, because that's past. Would not be. No, it shouldn't, because it would be more passive and not W-2.
Yep.
Well, I guess if there was a 1099, I see who the question's from and I will get back to you, but it depends on if you're working as a contractor, which is what I think you might be asking me about. I'm looking over to the screen.
Yeah, because that would be self-employment income potentially, and that would count.
That would, yep.
But if it were 1099 income on interest, which you would get a 1099 for interest on, that does not count, right?
Right.
So I guess it depends on what that is specifically.
Yes, self-employment. Yes. Mm-hmm. Yeah, they would count that against you.
Okay, thanks. Okay, so we're going to move into Medicare and taxes. Let's talk about how Medicare and something called IRMA, if you've ever heard that phrase.
Good old IRMA.
Good old IRMA. It can impact a lot of couples in that go and really beyond years.
Mm-hmm.
So first of all, what is IRMA? IRMA stands for Income Related Monthly Adjustment Amount. I actually had to look that up. I knew what IRMA was, and I've always used just the phrase IRMA. I didn't know what it actually stood for, but it's Income Related Monthly Adjustment Amount.
I'm not sure I knew either. Now that you say that.
So many of these acronyms, you just get used to that. The emphasis is in that topic is on income. The first part of that, the income related, because it's a monthly tiered surcharge. And again, back to our definition, that's a kind of tax. It's an additional cost that's tacked on to people's Medicare Part B and Part D premiums. But it only happens if you have income for singles or individuals over $88,000 and $176,000 for married couples. So let's look at what that actually means in action. Here we've got George and Martha. George and Martha are a high earning married couple. They both are Medicare Part B and D participants. The IRMA surcharges affect income from 2 years prior. So it's one of those look back elements, and it looks 2 years previous to the year that you're in and actually earning income or paying, I guess, those premiums. This couple was on track for $275,500 of MAGI, which is modified adjusted gross income in 2019. But on December 1st of 2019, George decided to sell a small stock that he bought for $10,000 in 2007. He sold the stock for $11,000, which resulted in a $1,000 gain. That $1,000 was taxed at the 15% long-term capital gains rate, plus an additional 3.8% net investment income surtax for a total tax bill of 18.8%. That's the 3.8%. The net investment income. That's another one of those acronyms, NIT. We call that NIT, NIIT, net investment income tax is another one of those tax that kind of comes into play when your modified adjusted gross income exceeds $200,000 for individuals and $250,000 for married couples. So George and Martha owe $188 of tax on the gain for the sale of that stock, right? 18.8% of $1,000. Or do they? Another one of those tricks.
Somehow I'm thinking no.
Yeah. So remember, my definition of a tax is any cost that increases as your income increases. So George and Martha are going to owe $188 of tax because of the gain of the sale of that stock, but that pushed them off the Medicare IRMA cliff. So instead of paying one particular premium, and the next slide is going to give us more details on that, it moves them into the next bracket for the premiums that they pay for Medicare Part B and D. So if you look at Part B, this Part B IRMA chart, that extra $1,000 pushes them into the next premium, which starts at $276,001. So instead of owing $297 each for their monthly Medicare Part B premiums, George and Martha are going to owe $386.10 per month. That's an extra $89.10. And you multiply that times 2. That's an annual total additional income related monthly adjusted Medicare Part B premium of $2,138.40. That's an additional cost that they're seeing or realizing because of that $1,000 of additional income.
That's crazy. But the gain on the sale was $1,000 and it's costing them twice as much.
Yes. But hold on, Jennifer, there's
But
more.
wait, there's more.
Wait, there's more. Yes, because it's not over. Because we also look at Part D. This is my Billy Mays coming out. Medicare Part D IRMA charges are also impacted. George and Martha are also going to owe an additional $19 per month for their drug plans, which is an extra $466 for the couple over the course of a year. So adding all of the IRMA surcharges together for the year, George and Martha are going to owe about an extra $100 a month, or about $2,600 for the year. Now, if you combine that with the $188 of actual federal income tax that they owe, we're realizing a tax of $2,792 on the $1,000 of gain. That's a 279% tax rate. That's worth repeating. That's a 279% tax rate on $1,000 of additional income. So a quick review: they sold stock, made $1,000 of an income gain, that increased their income there. The stock sale resulted in $188 of federal income tax. That triggers the new IRMA income tier, moved them into the new tier. The total IRMA surcharges were $2,604. So that extra $1,000 of income, again, triggers 279% real tax rate. They gained $1,000 and they're paying $2,792 because of that. Now, you see being pushed into the higher Medicare Part B and D premiums range is way worse than being pushed into a higher tax bracket, because being pushed into a higher tax bracket, only the amount that is over or into that next tax bracket is taxed at that next rate. So if you go from the 22 to the 24% and you're only $100 into that, only that $100 is taxed at that 24%. This one's different. This IRMA surcharge, the reason they call it an IRMA cliff is because it's a cliff. If you're over by $1 or $10,000, it doesn't matter. It's pushing you into that new range, and you're going to pay that new expense there. Now, keep in mind that your IRMA payments are determined by how much money you made not the previous year, but the one before. It looks back 2 years ago, which really results in this really catching people by surprise, and one that really kind of needs planning, because you are looking ahead. Your income this year is affecting 2 years from now. Now, another example here in the Medicare piece is to making sure that you enroll in Medicare at the right time. That's a really critical decision, because if you mess that up, you're potentially being hit by a penalty, which is not quite as high as that IRMA cliff. But here's the difference: this penalty is a lifelong penalty, so it can quickly be just as much or much more than that IRMA cliff. To help you understand, in our example here, we've got Jim and Ann. They're both 68. Jim retired at age 65 and Ann retired at 66. Prior to retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offered a retiree health benefit. And we've seen that with some of our clients, where you're able to continue that into retirement. Unfortunately, they didn't know that you had to enroll in Medicare Part B as soon as Ann retired. As soon as she was retired, that was a requirement. They needed to do that. So even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. Both Jim and Ann didn't realize that they had made a mistake until it was really too late. And thanks to the way that Medicare enrollment periods work, and some of you may be on Medicare, so you have experienced the timing there, they weren't able to begin that coverage until the next year. So there's a specific window that you're able to sign up for that. Now, in a worst case scenario, this might have resulted in a gap of coverage. So if they experienced a major medical need, that there could be a big shortfall there. But in the best case scenario, because Jim and Ann missed their deadline to sign up for that Medicare Part B element, they're each going to owe an additional 10% Medicare Part B base premium penalty forever. That's a penalty that they're going to pay for life. That will always be there because they missed that window. It doesn't matter. You can't make that up. That's not something like that you can adjust and correct, I guess, if you will. So you can see how that translates into real dollars. They owe $356 extra in 2021. And historically, we can estimate that premiums are going to be much higher for Medicare. That's that inflation element. So that 10% penalty is going to continue to grow as Medicare expenses grow. So over the course of a lifetime, that could quickly translate to a $10,000 mistake that Jim and Ann potentially made there. So for simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs. So they don't have to sign up for the Part D element, but just know that there's a penalty for that too. So that's another element that we are not getting into specifics on today.
Yeah, I don't know about you, but I'm starting to feel a little depressed about all this.
Yes, it's a lot. It's a lot.
It is a lot. Yes, and it's 7:45, so I'm going to try and speak quickly because there are a few other tax traps that we can face in retirement. And so yeah, after seeing that, you might be like, well, what else can we fall into?
Yeah.
And so there are some others that might be still a bit more in plain sight than most people, unless you do the calculations or have been tripped up by IRMA or what people aren't generally aware of those. But this is the fun part for us, really. You must plan how and when to use taxable, tax deferred, and tax-free assets to manage your income and tax brackets differently. And so, we do have this conversation with clients, which is, and the answer is different every year because it depends on if you've got Social Security income coming in, do you have a pension coming in yet? It's how do you distribute assets in the most tax efficient way possible from the various accounts with various different tax character. And so it's really can be fun to plan around. So I'm going to just try to talk through this quickly without blowing through it too much. So Sam and Mary, they've been good savers, and they're really looking forward to their retirement years and traveling and seeing their kids and grandkids. And so in addition to Social Security, they have $450,000 each in an IRA. Amazing how that happened. They have the same amount, $60,000 each in a Roth IRA and $300,000 in a joint bank account. So they want to spend about $8,500 a month or just over $100,000 a year. Where do you take the money from first?
Yeah, just to clarify, Sam's Roth IRA is $60,000, not $600. That was a typo there. So it is there. They are equal there at 60 each.
Wow, that'd be quite the Roth. That would be gold, wouldn't it? So most people think that first take the money, the after-tax money in the bank, and then take the tax-deferred money, and then take the tax-free money from the Roth IRA. This is the conventional wisdom. And really, the financial planning tools will sometimes assume that's going to happen as well. So it's been promoted by big investment firms and financial planning tools, but it's not a bad plan, but we know it probably might not be your best solution. And some years it might be your best solution, and other years it might not be. So not surprisingly, the topic has drawn the attention of academic researchers specializing in financial planning. And there's been multiple studies about this, how to prepare for retirement using a combination of Social Security, taxable accounts, tax deferred accounts like IRAs and pensions and 401ks, and tax exempt Roth accounts, because all that money comes out of a Roth IRA tax-free under current law. So you can see some study titles here. So the research has shown that the conventional wisdom probably is not ideal. So here's an alternative approach, and there are two key elements in the early years. First, use the taxable bank money for expenses, but also during the same period, accelerate IRA distributions during otherwise low income years, putting that money into Roth accounts potentially. Sometimes we tell people to spend it instead. This is the filling your tax bracket approach, which we'll discuss in a second. This alternative approach gives you more flexibility to use that tax-free Roth money strategically in future years. So it can be a great opportunity. A lot of that will depend on your time horizon, but does it make a big difference? And I think it really does. And in academic studies, the approach has been shown to increase portfolio longevity. That is how long your non-Social Security benefits last by up to 2 years. I would think there could be situations where it's longer even. But the big takeaway here is, of course, is that you've got to plan all the way through retirement, and it is a year by year decision, especially around how you handle your tax deferred assets. And of course, the disclaimer, see your tax professional for advice.
Always.
Yeah. And we do know, CPAs are great, but they don't, a lot of them don't do tax planning. They do tax returns. And so that's why it's kind of a beautiful merger of doing some tax analysis and bringing it to your accountant to say, you see a flaw in this plan, because they're often, I personally know of one CPA that our clients work with that does some planning, but the others, they don't have time, right? They're under the gun, so to speak. So yeah.
Yeah. So example 5 is getting more into that Roth IRA and looking at Roth IRA conversions. This is one of my favorite topics, and I think probably one of the most underutilized elements to a financial plan is looking at Roth assets. Those are really valuable assets in retirement. A Roth IRA conversion is simply the process of moving money from a tax deferred vehicle like an IRA or a retirement account or other pre-tax retirement accounts like a 401k into a Roth IRA. Our example, you can see Jill converts $1,000 from her IRA to her Roth IRA. In doing that, she's adding $100,000. Did I say 1,000? She's adding $100,000, excuse me, to her income in that year. The conversion income is going to be taxed at whatever Jill's tax rates are. So for that reason, it's recommended that prior to making any kind of conversion, you again consult with your tax professional and kind of look into that, and put some planning around that. That's something that we like to help clients with as well. A conversion doesn't need to be an all or nothing event. It doesn't need to be a complete conversion of your entire 401k or IRA. Oftentimes you find yourself in the middle of tax brackets where you're not quite at the top of a tax bracket. And we use this strategy called filling up the bracket, where we go in and want to utilize a Roth conversion to fill up a tax bracket. For example, in 2021, the 22% tax bracket for married couples filing joint goes from 81,000 to 172,000, to about that number. So if you file a joint return and your taxable income's at 100,000, then we may look at adding an additional $72,000 of income via a Roth IRA conversion that can max out that particular tax bucket.
Yeah, I want to add here, we like to marry that with the financial planning tool, because that will project out multiple years.
Yep.
And we can see if there really is a lifetime tax savings from that, and not just what this year's bucket does.
Yeah.
As well. So when you look at those two together, you have this great synergy of like, yeah, I might, maximize that bucket this year, but
Yeah. We can project, just like Jennifer was saying, and see that, in the next, 10 years, we're hovering in that 22% bracket. If we maxed out that 22% bracket every year for the next 10 years and converting money to a Roth, sometimes that lifetime tax savings is in the hundreds of thousands of dollars.
Yeah.
Oftentimes we see that. So that's a very, very, valuable piece there. These can be especially powerful in years when your taxable income is low, such as having high non-recurring Medicare, or it's not Medicare, medical expenses, or if you're a business owner, low sales year. Roth conversions were a really hot topic in 2020 when people had lower income, whether individual income or if you were a business owner, to say, hey, while my income is low, let's look at a Roth conversion. Does that make sense? It's common for people who retire early and have not quite reached Social Security benefits. They've not reached those RMDs, those required minimum distributions. So their taxable income is low in those gap years, we call them, and it may make sense for them as well. This is a good time to kind of pose the question, what's the goal? Because you kind of have to have that in mind when considering this, and know, what are you trying to do? Are you trying to keep income below a tax bracket threshold and avoid bumping to the next highest tax rate? Or are you trying to increase income to fill up a bracket to take advantage of that tax rate? And we kind of have that flexibility when you have IRA or pre-tax money to make some adjustments one way or another.
Yeah. Another point too, there can be what your legacy goals are. A Roth IRA is probably the most valuable thing you can leave an heir. And so it could be, it might not be your optimal tax strategy personally right now, but it might be a really great gift for your heirs as well.
Yep. Yep. Other strategies or possible approaches to kind of managing those income tax brackets might be withdrawing tax-free money from life insurance policies if you have those to keep income low. Selling highly appreciated stock for low or no capital gains if you're
That is
in
so
that
fun
range.
when that happens. Yeah.
Yes, yeah, when we have that
Really fun.
opportunity.
Yeah.
Yeah, that's you almost second guess that. You're like, wait, are we really paying no taxes on this? But sometimes there's that opportunity.
Yeah.
Just taking distributions from IRAs or 401ks to take advantage of a lower tax rate. Now, as we've seen, you can also consider, like I said, just those partial Roth conversions to fill up those lower tax brackets. We had a question I want to answer real fast. Is it better to do a Roth conversion before retirement or wait until after retirement? And really, that kind of depends on your level of income. If you're a high income earner pre-retirement and you're later on in your career and that income's as high as it's ever been, it may not make the best sense to do it pre-retirement. In some cases, it's almost the opposite. You're pre-retirement, you know what your income is, and you know in retirement, you're going to enter into something like an RMD. You've got lots of pre-tax money, and it may make sense to do something pre-retirement before that income starts to come in if you're retiring much later. So it kind of depends on your time of reference, I guess. It typically, what we will look for is lower income years. If you're lower income now, we're going to do the Roth conversion or at least consider it. If we anticipate that in the next few years, then that may be the time to be looking at that. Okay, so yeah, and starting right here on this slide, there are two other pre-retirement strategies that you want to make sure that you're considering, and both don't apply to everybody or to all people. The first has to do with how you use your health savings account if you have one of those. This would only apply to people that are covered under a high deductible health plan. So if you have one of those, and some of you may know that because your employer may offer a health savings account. Sometimes you may be in a high deductible health plan and have the ability to start your own HSA separately. The second has to do with small business owners. So if you are a small business owner, those are those who want to be really kind of extra tax savvy and saving in retirement can fund a company pension plan, which for certain high earning business owners can increase your ability to claim the QBI deduction, which is this qualified business income deduction. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax favored benefits throughout retirement. And we'll take a look at each of these. So if either of both of these might apply to you, go ahead and note that now, oh yes, I'm gonna skip this part. We don't care about noting that in the questions because you're not actually watching us live, but we're going to talk about this. And if you guys have any kind of questions, definitely always feel free to reach out to us with info on that.
Yes, sorry, my slide wasn't sliding. So those can both be important. And this is one charitable giving and tax planning that we utilize a fair amount with clients. So as we've seen throughout the presentation, for those of you who were in the earlier part, the critical importance of managing our tax deferred accounts, IRAs, 401ks, because once you're over age 72, you're forced to take out required minimum distributions, or as we refer in the industry as RMDs, and that can be troublesome for your tax bill. But many people make charitable donations supporting their favorite nonprofit with an annual gift. So let's look at how your RMDs and charitable giving may work for you with some planning. So we want you to meet Albert and Shirley. They look so happy. Who are in the 24% tax bracket. Now, the standard deduction for a married couple filing a joint return in 2021 is $25,100. But Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction for 2021 to roughly $27,800. This means they will receive no tax benefit for any itemized deductions unless their total exceeds that $27,800 mark. So if Albert and Shirley have 15,000 of existing itemized deductions, say from state and local taxes, deducting medical expenses and mortgage interest, what happens tax-wise if they donate $5,000 to charity? They get no federal income tax benefit from making that charitable deduction because it doesn't exceed that 27,800 when you add the two together, the charitable plus their other deductions. So, but that's not to say they shouldn't do it, but they should understand it's not helping them save on taxes. We would never encourage someone not to not donate to charity just because it doesn't save them on taxes, but there's a strategy here. If you're over 70 and age 70 and a half and have an IRA or inherited IRA, there's another way to give to charity that's simply writing a check, other than simply just writing a check. And it's called a qualified charitable distribution, or a QCD for short, because we are all about acronyms in our industry. So let me explain how it works to you so you can see why a QCD is so powerful. And first, some rules. If you are 70 and a half or older, you can make a qualified charitable contribution up to $100,000 each year from your IRA. If you're married and both of you are 70 and a half or older, and both of you have an IRA, you can each make up to $100,000 qualified charitable contribution from your IRA, from your own IRA. So you can really push some money outside of your tax return. Second, any qualified charitable distribution you make counts towards satisfying your required minimum distribution for the year. So, however, when you make the distribution from your IRA, it must go directly from your IRA to the qualified charity, or you can receive a check from your IRA custodian and made payable to the charity. So that's what we do. We just ask our custodian to write a check to the charity that our client wants, and then the check is mailed to the client, and they can still hand it over, but we want it to go directly into the charity's name.
And this is different from a rollover, right? Because if we're rolling over assets from a 401k to an IRA, we can avoid the taxes, even if whoever's holding the 401k writes a check. So like if it were your account, Jennifer, they can write it right to Jennifer, and you've got I think it's a 60-day window.
Yep.
To put that money into an IRA without having to pay taxes. That's not the case here. That check needs to be written to the charity, not to Jennifer.
Right. Or it will not, or this whole strategy doesn't work if that happens. Yeah. So, here's the odd part. Even though you gave to the charity, you get no income tax deductions. So why would we suggest that strategy when you get no deduction for giving to the charity? Because when you make a qualified charitable distribution, the distribution from the IRA is never counted as your income when you compute your taxes. So let's see how that helps our friends Albert and Shirley. So let's suppose Albert and Shirley do what many retirees would do. Albert takes his required minimum distribution of $5,000 at the beginning of the year and deposits into the bank. And then he's done with his RMD for the year. He has paid his taxes and satisfied that requirement from the IRS. Now, being charitable people, they donate $5,000 to charity. The end result is that the charity gets $5,000 and everyone gets that part, right? That's pretty clear. But let's look more closely. By virtue of giving to charity this way, Albert and Shirley's $5,000 charitable contribution will actually cost them a total of $6,200. Why? Because the $5,000 RMD that went to Albert's checking account at the beginning of the year still has a tax cost. So remember, the couple is in the 24% tax bracket, and 24% times 5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is the $5,000 plus the $1,200, or $6,200. So remember, the gift didn't impact their standard deduction because when you added it with their other deductions, it didn't exceed the standard deduction, so it doesn't get used on their tax return. So the RMD behind the gift just added to their income. And since they couldn't use the standard deduction, it didn't exceed their standard deduction. So now let's see what happens if Albert and Shirley use the QCD, qualified charitable distribution, to give the $5,000 to charity. Instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert would simply have the IRA custodian transfer the $5,000 RMD directly from his IRA to the charity. And as we mentioned before, through a check made out to the charity. So that satisfies Albert's yearly required minimum distribution because he's over age 72. Now, the charity is in the same position as before. They receive $5,000, and that's a great thing. But Albert and Shirley, however, are in a better position. They still give $5,000 to charity, even though they receive no deduction for making a contribution. Their IRA distribution is excluded from their tax return since the money went directly to a charity. Their total cost to give the $5,000 to charity is $5,000 since they don't have to pay tax on that money. So a $1,200 savings over a previous example. So simply by knowing how to use the tax rules to their advantage, they came out ahead, and they did it all without ever getting a deduction. So it's a really cool tool to use for sure. Just one last point there. I do want to emphasize you do have to be 70 and a half or older though to make that happen. So anyway,
Yeah. So and just to clarify, when you say without ever getting a deduction, they're still taking the standard deduction. They get to still have that set full standard deduction, but that money's kind of coming out. And not only is it the tax savings element, but as it's indicating, it's reducing your RMD, so that if you've got money that you're taking out of your R&D, oftentimes that required minimum distribution is money that you don't actually need to pay expenses. So it's kind of forced taxes. In some cases, you need those assets anyway, and you would have taken that money out anyway to fund your living or lifestyle. But if you didn't need that money, it's better to leave it in there. In a lot of cases, still continued tax deferred. So in this case, you're not having to increase or I guess add on top of that RMD. It's satisfying that RMD. You're essentially taking that off the table there.
Yeah, and it's not an all or nothing situation. So sometimes clients, for example, have an RMD of $25,000, and they might give $5,000 to charity and take the remaining 20 as a distribution into their checking account. So you have complete flexibility of how you do that. But if you are charitably inclined and you are 70 and a half or older, it is beneficial to you to make those charitable contributions via this qualified charitable distribution.
Yeah, that's one of those no-brainers. If you're giving that money anyway, and you're taking RMDs, there's really no downside to anybody. You are the charity to be doing it that way.
Yeah.
Okay, so key number, no, not key number 4 just yet, but as far as the charity, we all know that charity really starts at home. So it's a natural question or natural thought to think, how does retirement tax planning really figure into that? Which is a great question because the government still wants their share of the tax deferred assets when you pass away. And like we've seen, how do you set things up? I guess how you set things up, that's important. That really matters in this whole thing, which leads us to key number 4. That was a slide ahead. There we go. That you want to organize your assets for your family's benefit. This is that estate planning element to that tax planning pieces. Okay, so estate planning is always a relevant topic, even though people don't like to discuss death. But that's as far as the statistics that we've seen, everybody's going to die. That's going to happen. That's going to be a part of your plan. So even though that's a maybe uncomfortable topic, that's something that really everybody needs to be considering and talking about. But we're not going to discuss it in the traditional way. That's because the new law really actually excludes estate tax, it's estates valued up to $11.7 million from the federal estate tax, meaning that really only the tiniest fraction of people need to worry about estate taxes today. Now, you still may face an estate or inheritance tax at the state level. We're not going to be getting into the state level today. We're focusing kind of on the federal side.
And we should probably point out that is a hot topic on the table in DC about potentially lowering that amount that can be passed federal tax free. So keep your ears open.
There's a couple of those on the estate planning side
Yeah.
elements or strategies that are kind of on the table to
Yeah.
potentially be changed.
Yeah.
So either way, it's still a very important tax issue, which kind of remains around how your assets are received by your beneficiaries after you die. One example is making sure that married couples plan for their available step up in basis. And just like Jennifer mentioned, this is one of those items that's kind of on the table on being discussed on changing that. And I know just that term itself, step up in basis, if you haven't talked about that, I mean, that's can easily be a very confusing term. What are you talking about? But simply put, a step up in basis is a tax rule that readjusts the value of an inherited asset, so that its value is not what your spouse or decedent paid for it initially. Instead, it's a stepped up value that's the price on the date of death. This can be a really huge tax break or make it be a tax difference, and as we'll see in the example here. So it's likely that most assets that you own, other than retirement accounts and annuities, are going to be eligible for a step up in basis. So if it's not one of those retirement accounts, or if you have any kind of existing annuities, they're likely going to be eligible for that step up process. So let's look at Phil and Mary here, who live in a separate property state. They are married and they own a variety of taxable investments in a joint account known as joint tenants with rights of survivorship. We have lots of those accounts, and that can be as simple as just a checking account at your bank is oftentimes a very similar type of account where they both own that jointly together. And the investments have long-term capital gains of $120,000 in that account. So that account has grown. So one day, bad news arrives. Phil is diagnosed with terminal cancer, and they've given him 18 months to live. We're dealing with some very uncomfortable time for Phil and Mary. So now let's see how this works in two different scenarios. In the first, Phil and Mary make no planning changes to their assets. They leave it in that joint tenant with rights of survivorship. When Phil passes away, Mary's going to receive a step up in basis on Phil's half of the joint account, which is $60,000. She still faces a future $60,000 of unrealized gain on her half of the account. So that's half of that $120,000 of growth that they've seen in that account. Simply put, that means that if Mary decides to sell all of the assets, she's going to owe taxes on $60,000, her portion of that gain there. Now, suppose that upon Phil's diagnosis, Mary and Phil moved all of their investments into one account in Phil's name. Then, as long as Phil lived longer than 1 year, Mary would receive a full step up in basis on that entire $120,000 account. So right upon this diagnosis, they had the know-how, or somebody informed them that, hey, it maybe makes sense to move this entire account into just Phil's name. So simply put, at the time after Phil passes away, Mary could sell that account and essentially pay no taxes if there were no additional growth, I guess, after that was moved over into Mary's name. Now, when you sell all of your investments, would you rather have a $60,000 of with no taxes, or would you rather pay the gain on that $60,000? That's obviously a rhetorical question. So let me say that planning around death can definitely be hard because you've got that emotional aspect to it. But this is where really a professional can help, because emotions are essentially removed from the situation from their standpoint, and they can assist you to make those good decisions that may seem hard at times. You kind of have that secondary input where they're not emotionally tied to the situation, at least not as emotionally tied to the situation as you might be. And I say that just because there are times that we definitely get emotionally tied to our clients and have concerns with all the situations that they're going in. But it's much easier for us to have that different perspective from the outside to say that, hey, I know this is going on, but this is still beneficial to you in this situation.
Yeah. Tough stuff for sure. So we'll go on to something a little, a little less sad at the moment. But so now maybe you're someone who has managed to save up quite a bit in your IRA or 401k, and you feel pretty confident that you'll be comfortable in retirement and are hopeful that you will leave behind the account to your children. And in the past, we would have recommended that because with the right structure, your heir could withdraw money throughout his or her lifetime, possibly over decades. But that changed with the passage of the Secure Act in December of 2019. Now, all beneficiaries of inherited accounts, with some exceptions, must withdraw all of the money within 10 years of the owner's death and pay taxes on that money. So it really truncated the amount of time you could take money out, and it accelerated how taxes were paid for and limited growth. So this restriction on what was called stretch IRAs shines a light on how important tax planning is. Laws can change at any time, so you need to have a plan and revisit that plan regularly. So let's look at Pamela and Kyle as an example of what choices beneficiaries have when they inherit IRAs and can no longer stretch distributions over their lifetime. The first scenario we have involves Pamela and her son, Kyle. Pamela unfortunately passes away, leaving the full IRA to her son, Kyle. He's an only child and the sole beneficiary of the IRA. We know that Kyle has a maximum of 10 years to withdraw the IRA monies to meet required minimum distribution rules. Kyle likes regular distributions, so he chose to take equal distributions of the funds over 10 years. The IRA earns an average of 6% of a rate annually, so it's still growing while the money that's still in there is still growing. This payment would be calculated to be $54,347 to Kyle each year, to be exact. Kyle would have to add this amount to his income on his tax return for the next 10 years. The second scenario for Kyle looks a little different. Kyle lost track of time and he has already reached year 10 of the required minimum distribution window. Yeah, he really did lose track of time. But anyway, so since it is year 10, he must now take out the full distribution in 1 year, assuming the same 6% rate of return is earned annually on the $400,000 IRA. We can calculate the IRA balance has grown to $716,339. I want to say, and 53 cents or something. That's so exact. But Kyle must take the full $716,339 as a distribution in year 10 and pay income tax on that amount. And Kyle will be in the top tax bracket in year 10. So it definitely pays to plan and think through be aware of what's going on financially. So anyway, go ahead.
Please, yes. Mike. Yeah. So this is we're getting toward the end here. And yeah, I'm sure if you were with us last week or go back and watch the full video and you've gone through all this information, you've got to be thinking, goodness, how in the world am I ever going to manage all this? Which is a great question. So we're going to try to bring it all together and summarize everything here. So we started with a clear statement about the problem. Retirees, they often pay more taxes than expected because of confusing system treatments and kind of how the tax system works and treats different incomes differently. And there's lots of hidden taxes and penalties along the way. So let's do a quick review on what we've learned in the context of those 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire and having a knowledge of what that is. And we also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and to start taking advantage of both funding a Roth accounts to fill your brackets, as well as those tax-deferred vehicles like an IRA or 401k. That's something that you do through your early retirement years when you're in low tax brackets or low tax years. We also looked at Social Security and taxes, plus the importance of couples having benefits. Gosh, what am I trying to say here? The importance of couples having a strategy that considers, the surviving spouse. Completely lost my train of thought there. The surviving spouse element is one that often people don't think about when it comes to Social Security. And we saw also Medicare has its own tax-like structure. That was one of those expenses that isn't traditionally called a tax, but we view it as a tax because it increases as your income goes up. The IRMA cliff, if you recall, we saw the importance of signing up for Medicare on time, because that's a penalty that you don't want to be paying forever. And that's right in the middle of those go-go years. Let's see. We saw that because starting in, it's talking about Medicare, starting in the middle of those retirement years, you'd be confronted with those required distributions, which we just talked about today. And we've seen the importance of planning your income needs kind of before then, and the tax issues that are involved with that. And then we saw that the importance of setting up your assets and managing them during the later years of retirement, so that you can preserve the most for your heirs and leave them with the most tax flexibility when they actually inherit those funds. All of those items really together lead us to the obvious solution to our original problem. Because your tax exposure is going to change throughout retirement, you need a tax strategy that's going to do these three things. It's going to anticipate how and when you tap the assets to cover your personal expenses. It's going to understand the range of taxes that you're going to face at the various stages of retirement. And then it's going to manage your actions so that you pay the lowest tax rates possible kind of throughout that process.
Yeah, so everyone's situation is unique, but it's not impossible to navigate them. So approach your strategy thoughtfully. And also bear in mind, the answer can be different every year. Sometimes there'll be early years of retirement where you don't have any income because you haven't filed for Social Security yet. And those can be a great year to sometimes sell assets and fall within the 0% capital gains rate. It can be a good time to maybe convert IRA assets to Roth IRA and pay income tax at a lower rate. There are many different strategies. And those strategies might not be available to you when you're 67 and taking Social Security and potentially a pension as well. So it is not we figured it out one time sort of solution and we got it covered. It's something that really has to be thoughtfully considered every year. So please do contact us if you have questions. We'll do our best to answer. I always joke with my CPA because his answer is always, it depends. So we could be in that situation with you, but we'll try to answer them. I mean, if you're a client, we have the data and can answer the question, but otherwise, if you are a guest that we are not familiar with, you can reach out to us at info@Summit RVA. There's also a link on our website to book a phone call. Our website is summitfinancialpartnersrva.com. And we are glad you joined us for Facebook Live /webinar, our little hybrid meeting. And hopefully we'll see you again in a couple weeks. Thanks.
Thanks, everybody.
Bye.